The first one's GDP, 2, unemployment, 3, the health of the US consumer, and 4, the inverted yield curve. So we're gonna begin with GDP. Adjusted for inflation, GDP rose at an annual rate of 2.9% in Q4 of 2022. That's represented by the green bar. This is slightly down from 3.2% in Q3 of 2022. It's down from 6.9% in Q4 of 2021. You can see the economic contraction during the Great Recession, as well as during the pandemic. So during the pandemic, it goes even lower. It just got cut off the charts. I do not believe that this recession will be as severe as those, but as you can see, we're not in the thick of it yet, so not even close. So I want to point out that in Q1 and Q2 of 2022, those smaller red contractions, so that was mostly attributable to the trade deficit. Exports add to GDP, imports subtract. During the pandemic, we were exporting less and importing much more. So regarding this GDP report, it was the strength of the US consumer. It was consumer spending that helped to drive fourth quarter gains. It basically means that US consumers, they're still spending at healthy levels. Consumer spending averages 68% of GDP, that's at pre-pandemic levels. In Q4, it was at 70.6%. What hurt GDP was the weakening housing market and cost cutting from businesses. Okay, so for 2023, we're starting off the year January 1st with some good stats, 2.9% annual growth. However, as you can see, we are on a downward trajectory and we're losing momentum. So if you want confirmation, you could just listen to the earnings calls by companies on the stock market. The theme is a slowing economy and slowing demand. But I mean, I don't think that's news to anyone, but it's just confirmation. So here's the situation. Inflation hit 9.1% in June. The Federal Reserve, they turned off the money printers, they raised interest rates. That has brought inflation down to 6.5%, but it's also putting pressure on the US economy. So some sectors, they're more interest rate sensitive than others, and they're feeling the pain more quickly than others. So take a look at real estate, that's a good example. Mortgage originations, they're down 86% year over year. So I don't think anybody's gonna argue that monetary policy is dictating the economy. So the Federal Reserve is hoping that their restrictive monetary policy, it's gonna bring down inflation and only slow down the economy and avoid economic contraction. So in plain English, the Fed is hoping that the economy will continue to grow, but just at a slower rate. So this is what they mean when they say a soft landing. They don't mean a mild recession, they mean maintaining positive GDP. So Luke Tilley, the chief economist at Wilmington Trust said, and I quote, "If we continue to get strong job growth and consumer spending on services, and companies do not cut back on capital expenditures, I think that adds fuel to the soft landing story." And a lot of people are buying into this story. They believe that the worst is over and they believe a soft landing. However, there are many people that are skeptical of this because of economic indicators. So listen, people do not want a recession. However, people don't want to be out of touch with reality either. So I believe that we're all adults and that we can handle the truth. If there's going to be a recession, there's going to be a recession. We just don't want to be misled or unprepared. So I just want to have an honest conversation about this. So let's talk about the labor market and unemployment. So first you have to understand that real wages are down and they continue to decline. So according to the government, the purchasing power of everyday Americans fell. Wage growth has not been keeping up with inflation. So that trend, it's expected to continue this year. And to make matters worse, unemployment will rise. So job cuts have been accelerating at tech companies. In tech, they don't like to call it downsizing, they like to call it right-sizing. It sounds better. Outside of tech, they call it what it is, they call it layoffs. In 2022, the tech sector announced 97,000 job cuts. This is up 650% compared to 2021. And when companies announce layoffs, they usually do them in multiple rounds, so they're probably not done yet. IBM announced 3,900 layoffs, Salesforce 8,000, Microsoft 10,000, Alphabet, so Google 12,000, Amazon 18,000. And now the layoffs are starting to spill outside of tech. Dow Inc., so that's the big chemical company, announced 2,000 job cuts. They're trying to achieve $1 billion in cost reductions. 3M in manufacturing announced 2,500 job cuts. They're saying that demand has weakened significantly in late 2022, and they expect lower sales in 2023. So we see it spreading into finance and banking. Bank of New York Mellon, 1,500 jobs. Goldman Sachs, 3,200 jobs. We see it in retail, Bed Bath & Beyond. And there's gonna be more layoffs when the bankruptcies come, more bankruptcies come. And I wanna say this because I think this is very important. Something that I don't like about the headlines for unemployment and the unemployment reports is that they can be very misleading. So the rate of unemployment is cited at 3.5%. However, the US Chamber of Commerce just wrote that we have 2.95 million less workers today compared to pre-pandemic levels. So you can see that from the labor participation rate, so it's not hidden data, but the headlines can be very misleading. If you can't find a job for long enough, then you're no longer considered unemployed. However, I don't want to discount the fact that many seniors decided to retire early under good or bad circumstances. Anyways, just take that into consideration when you read the headlines. That's all I'm saying. Regardless, unemployment will go up. The expectation is to 4.4% to 4.9% this year. That means more than 1 million more job losses this year. And if it continues into 2024, then it could be more. Now, GDP was propped up by the strength of the US consumer. Okay, so for this year, we know what we have in store for us. It's the continuation of declining real wages, so purchasing power falls, unemployment is gonna rise, and we know that retail sales are declining. Americans are cutting back on their spending. The US Commerce Department reported that retail sales fell by 1.1% December, following a 1% drop in November. So Moody's vice president said, and I quote, "There are cracks appearing in the resiliency that consumers have shown in 2022, as higher prices and interest rate increases finally take their toll." So Moody's expects that consumers will now be more selective in their spending and will postpone purchases. And the data shows that more Americans are now relying on their credit cards for day-to-day living expenses. So 46% of credit card holders carry a balance month to month, and now, because of higher interest rates, it's more expensive to do so. Credit card defaults are rising, and a lot of households, they're not facing the reality and they're not adjusting their spending habits. So please don't let this happen to you, because the economic situation is gonna get worse before it gets better. Okay, so the narrative in the mainstream media is a soft landing. The thesis is on the strength of the US consumer and a strong labor market. But the data is screaming in our face that the US consumer is weakening and that unemployment will go up and that negative real wages will persist. So that's why I'm skeptical of this narrative. And outside of US consumer data and unemployment, you have the bond market indicating a recession. The yield curves are inverted. A yield curve inversion, the 2-year and the 10-year, has preceded every recession since the 1960s. So obviously you can't just look at the inversion to predict a recession, but this is just an additional warning sign. The yield curve has accurately predicted the last 6 recessions. All right, so I'll end with this. The street estimates for this year are: real GDP growth in the US will be 0.3%. CPI inflation will end the year at 4.0%. Unemployment, 4.5%. 10-year treasury yield will be at 3.8%. I believe that we will not have a soft landing. However, I do not believe that this recession will be as bad as the Great Recession. Inflation, it's my belief that it'll get stickier in the 5% range, and the Fed will have to maintain a hawkish stance for the time being. So what I'm saying is that things will get worse before they get better. But I just want to say, listen, it's not going to be the end of the world, and a lot of economic opportunities will arise during the turmoil. So be prepared. Don't get yourself into financial trouble as the economy worsens, and jump on the opportunities when they pop up. When there's blood in the streets, you buy property. So I'm not talking about not just realty, not just physical real estate. I'm talking about stocks, cryptos, also real estate. As they fall in price, that's the best time to buy. Please subscribe. I thank you for all the support. and wish you a very nice day.